What's up, everybody? I hope you're having a good week so far. Today, I want to take a step back and look at the macro picture of what's going on, not just in the US with our economy, but in the entire world. I'm going to step back from our day trading analysis a little bit here, and it's inspired by this exchange on Twitter that I read last night to kind of prep myself for the week. Normally on Saturdays and Sundays, I check out of Twitter and off of Instagram, but Sunday night is when I typically come back to see if I missed anything over the weekend. And this exchange that you can see here between Elon Musk and Cathie Wood caught my eye, and I think it's important that we talk about a couple of the statistics that she points out. So Elon said, "What do you think of the unusually high ratio of S&P market cap to GDP?" He tweeted that to Cathie, to her ARK Invest funds. For those of you that don't know, Cathie Wood runs a bunch of different investment funds. They buy stocks in different sectors. She's a big believer in Bitcoin, Tesla, SPCE, Virgin Galactic, a lot of the companies that you're hearing people talk about right now. So he says, "What do you think of this unusually high ratio between S&P market cap to GDP?" So I wanted to kind of figure out, well, what does that actually look like on a chart? What is the history of the S&P market cap versus the GDP? So that took me to longtermtrends.net, which is an awesome website. Highly recommend you check it out. And you can see here, this is the Buffett indicator that they have at the top, which is market cap to GDP, the Wilshire 5000 it's also called. But if we go down, you can see here we have S&P 500 to GDP ratio. Now, if you're looking at this chart, we can only see, and I'm going to zoom in a little bit here, just so you guys can see it nice and big. We can only see from 1980 right now up till 2020. And if you look, here's that dot-com bubble in 1999. We were over 0.1. Here's the housing bubble at 2007, 2008 at again 0.1. And you can see currently, as of April 2021, we're well over the levels that caused both of those bubbles to happen, to pop, and to see markets correct, especially here in the United States. But if we zoom out and we look at the entire history that long-term trends gives us, you can see we go all the way back to 70? Yeah, it's wild, 1870. And you can see here, we've actually been way higher on this S&P 500 to GDP ratio than we are today. In fact, the major stock market crash, the Great Depression of 1929, that was actually closer to 0.3. So we're a little bit past halfway to the levels that we were at when we saw the Great Depression happen. So I don't like to buy into this short-term view of, oh, we're over the dot-com bubble and we're over the housing bubble, so it's got to pop. I don't buy that, and I don't think Cathie Wood buys that either. And that's what she said to Elon. So just really quick, we're going to go back to the tweet in a second, but look here. Back in the early 1900s, late 1800s, we were over 0.4, even 0.5 on this S&P 500 to GDP ratio. So what she says in response to Elon is exactly what that chart right here shows you. She says in the late 1800s and early 1900s, as the telephone, electricity, and the automobile were emerging, the U.S. equity market cap relative to GDP appears to have been, what did I just say, 2 to 3 times higher than it is today. We need to verify this, difficult to get data, but she has a hypothesis. And basically what she says in her thread here is that because of technology at that time, which was the telephone, electricity to everyone, and the automobile, those three things drove innovation and pushed us into the roaring 20s, basically. The gold standard was also in force. Now she's saying we have even more technology. If you look here, the technological enabled innovation evolving today dwarfs that of the late 1800s and the early 1900s. We have I've never even seen this word, genomic sequencing, robotics, energy storage, artificial intelligence, and blockchain technology. Moreover, she's saying Bitcoin could be today's gold standard, increasing purchasing power. So she wants to verify this data, but she thinks that this time is different are dangerous words when you're talking about forecasting markets. Most forecasters use post-World War II history to guide their data. On that basis, never has the equity market been higher to relative to GDP. But if you go back in time, like we just showed in the late 1800s and early 1900s, there's plenty of room to grow. And she's saying the innovation that happened is why we saw the S&P 500 to GDP ratio so high. And because we could be going into a new innovation age now, we could see it get that high. So that was the first thing that I found really interesting, is that she believes that Bitcoin is basically today's gold standard, is what she's saying, and that we could see a much higher ratio between the S&P 500 and GDP than we are currently seeing if you were to just zoom back and see the bigger picture. I think it's also important on this page here, before we go to the money supply one, I want to just show you with the Buffett indicator. Yes, valuations are high, because that's what this is saying, is that here in the dot-com bubble, you were able to see that it was way higher than the mean average. Here, even in the housing bubble, stock prices were higher than their valuation should say that they should be. Here, being that we're so high on the Buffett indicator, even if we could go back in time all the way, you can see being over 2 almost now on the Buffett indicator doesn't scare me necessarily, because maybe the way we've valued companies only over the last 50 or so years could change. It could be going into a different era of this modern monetary theory. And that leads me to my point here with the M2 money supply versus inflation chart. So we're looking back to 1870. Specifically, I just want to show you here in 1943, M2 money supply, which is the black line on this chart, peaked at 16.78%. Quickly after that, in 1946, so that was we'll call it 45, a year or two later, inflation is up at 18%, and the M2 growth is down to 8%. So you can see very quickly, they print more to help pay for the war or to pay off war debt. Inflation then kicks in. We then start to see more modern monetary theory applied. The money rate grows at a steady rate, just under 10% or so, while inflation moves between like 2 and 12%, 13%. Since the 80s, basically, inflation has been held very tightly under 5%. They've worked really hard to use modern monetary theory to print money and to control this system that we all operate in, basically. Now, seeing M2 money supply growing at 24, 25, 27% here in 2020 and 2021, and seeing inflation stay so low, historically, you would see them flip-flop. You're going to see inflation kick in, and you're going to see the money supply decrease. Is that coming? I don't know if we can say that it has to do that, because it has in the past. Just like we talk about investment returns, past performance does not indicate future returns. Here, we could be just breaking into a new understanding of the way that US dollars here that are, what we're calculating with the money supply, we're just entering a new quantity, a new playing field of how much money is printed and how that money is being used and how inflation is controlled. Could I be wrong in this video? I'm not saying this is even my opinion. I'm just giving you my analysis, but I could be wrong, and we could definitely see this come and completely reverse. We could see there's a lot of people that are saying inflation's going to 15, 20%. I'm going to just continue to live day by day and say maybe what's happened in the past isn't exactly what's going to happen in the future because of this new technology that we're living through, because of all of the changes that our society is facing. I think we have to open our mind to the potential of it not being like it was in the past. Going back to what Cathie was saying, this time could be different. She says here that this technology can lead to good deflation. She said the deflationary forces associated with the 5 major platforms evolving today could be much more powerful than those caused by the telephone, electricity, and the automobile. And then she said bad deflation, which is creative destruction, could compound the deflation. Since the tech and telecom bust, many companies have catered to short-term oriented shareholders, leveraging balance sheets to repurchase shares and pay dividends while neglecting to invest enough in innovation. So she then says deflation should lower the velocity of money, a mirror image of what happened in the 70s, and if consumers and businesses expect prices to fall, many are going to defer their spending, and as a result, the rapid growth in the global money supply is unlikely to unleash generalized inflation, except perhaps in asset prices, which means stocks go up. So what she's saying is if we look at the velocity of money, it's going to be very much like the 70s where people defer their spending, and as a result, the rapid printing won't necessarily unleash inflation on our everyday goods, only in asset prices. If we go to the bottom of this page here, again back on long-term trends, here's the velocity of money. We're going back into the 1800s again. The velocity of money, it says here, is a measurement the velocity of money is a measurement of the rate at which money is exchanged in an economy. High money velocity is usually associated with a healthy economy, and low velocity is usually associated with recessions and contractions. So if we look, velocity of money is the slowest it's been almost since 1930, okay? That means that you would think we're in a recession, we're in a contraction, we're in some type of low economic position. But if you look back to when the velocity of money was high, when was it? Back in the late 1800s, early 1900s. Velocity of money was high. So you saw strength in the economy then with, going back to the other chart, with that S&P 500 to GDP ratio high as well. So could we eventually make our way back to something like that? I don't know. But if we're going to put this whole theory together, you would probably see the velocity of money match. Again, going back here, see how it's high over 3 and over 4? You got to see it match that same level on the S&P 500 to GDP ratio. So as the S&P 500 to GDP continues to climb, we should watch the velocity of money, because if it continues to climb, if it can climb from where it's at now, then that would tell you that we could be heading into a roaring period like we did in the early 1900s of innovation. But maybe not. So we have to just be aware of all these different moving parts. Just notice the velocity of money was greater here than it is now. The difference being here on the market cap to GDP, as we're heading higher, you're disconnected from the velocity of money, which I think is reflected in this Buffett indicator, showing you that valuations are way higher than they should be. So that's my full thought. That's like taking Cathie Wood's tweets there, putting some real charts to it, and showing you where we stand. But I want to know what you guys think in the comments. Could we be in this new plateau, this new playing field of modern monetary theory? Money will be printed at levels they've never seen before. Inflation will be suppressed except in asset prices. Where do you think, is that a possibility? Or do you think this has to pop? Its reckoning day is coming, and when it does, it could be the worst pop we've ever seen. Either way, it's going to be an extremely exciting next couple of years, and I look forward to growing and moving through it with you guys. So hit me in the comments. Let me know which side of this you're on. Let's create a dialogue. I always like to hear what you guys think. I appreciate the time. If you found value here, just give me the thumbs up. You know I appreciate that. And subscribe so you don't miss any of my future videos. The rest of this week, I'm a little busy. Got some family in town. Going to be hanging out at the beach. So might be a little slower on the trading videos, but definitely going to be back next week with more for you guys. So let me know what you think. Are we going to new highs, or is the bubble popping? I appreciate you guys very much. I'll see you in the next video.